Hello friends, welcome to our channel. If you are watching first time, please subscribe our channel. Today we are going to discuss about how Indian IPO procedure and what is the overall IPO overview, and also what is the differences between India and international IPO related, and what are the tax implications regarding the IPOs for the companies, for the shareholders or for the existing shareholders. So for company and new shareholder and existing shareholders, all these tax implications also will discuss in a short period. See, regularly India's IPOs overview derived by the SEBI guys. So SEBI will give the instructions how to follow. There are two routes for Indian IPOs. One is profitability route, one is qualified institutional bankers. The qualified institutional banker means they will invest into the startups or well established companies. If they invest in the startups, based on their investment proportion, we can go for IPOs even if you don't uh, compile the profitability conditions. That I will tell here. I will tell the conditions and everything, please. And also mandatory draft red herring prospectus has to file to the SEBI for our IPO, for Indian IPOs. And also, right, in IPOs we have two major exchanges. One is National Stock Exchange and one is Bombay Stock Exchange. We need to compile those conditions. And if you go the next step, so this is the step-by-step procedure. First, you need to appoint one merchant banker. Merchant banker means the mediator for the SEBI and us to create that procedure. And then you need to do one due diligence. Due diligence means like you need to check all feasibilities, the tax side, and then company's marketing side, and also from compliance side, promoter side, everything. All the due diligence report will come. Based on this due diligence report, our IPO procedure will go further. And then after the due diligence, we need to give red earning prospectus to the SEBI. If you file this SEBI will give some observations on this filings. Once you completed that observations and if you satisfy the SEBI's conditions in year, then the red earning prospectus can file. Once you file, no, you can start the IPO open and close process. So generally you give some period to subscribe the channels, subscribe the shares and everything, no, that will come here. Post that, allotment and listing will happen. Allotment will be based on their pricing and that course, and listing will happen. That procedure you may know, but all this the mandatory procedure has to follow. You have to step by step to complete the IPO. And then what are the conditions for the IPO? This is the major part of this video. See, there have two conditions to initiate the IPO from Indian companies. One is profitability conditions. So without any investments banker, you can go by this route. One is institutional qualified bankers investment route. So first we will discuss about this route. The first one, if you want to go by your own without any investors help, you need to follow few conditions. One is net intangible asset conditions. At least greater than or equal to 3 crores in each last financial year. I mean, this has to condition your net assets, net tangible assets has to be more than 3 crores. And then profitability record. This is the second condition. This is the first condition. The second condition is you have to compile all conditions. Distributable profits means this is the profits available for the dividends should be there for at least 2 to 3 years. At least if you want to go for the IPO, you have to be show profits, not show. You have to earn profits, which is eligible for refunds for the period of two, at least for your last 3 years. And the net worth, all your last 3 years net worth should be more than or equal to 1 crore. And also name change restriction. If you changed the name in the previous years, so earlier it was X company, now you converted to AB company. So if the new name should at least earn the 50% of the revenue. So if your total revenue is 30 crores, you should earn 15 crores of the revenue invoices should be on the new entity name. That is the one condition. And the size, the earlier IPO is already issue size is IPO is less than 5 times of pre-issue of the net worth. This we can compare the less than 5 times of the pre-issue of net worth. Pre-issue net worth means the earlier net worth what you show, that is the less than 5 times has to be there while you follow in the conditions. This is the first major route for the initial public offer for profitability route. The second one is institutional qualified route under this regulation. This is for regulation 6.1 and this is for regulation 2 as per SEBI regulations. Without profit track. So you don't need to do this profit and everything in this route. Here only 75% are equal more percentage of the net offer from qualified. Say suppose you are going to offer 70 100 sorry 1000 crores of the capital. So these qualified institutional bankers has to invest 75%. I mean 750 crores, and then rest of the public can invest under this route. You without any profits, you can go for the IPO. These generally used by startups or other loss-making companies by using this route. So these are the major conditions you have to compile to go for IPOs. And the next is Indian IPO compliance. So generally after IPO or else while IPO you need to demat your shares, and also your promoters was not defaulter in any act or willful misconceptions or money laundering, but any loss you don't have to convict. And winding up petitions has to be clear, or no winding up spending ongoing winding up pendings at this time while you going the IPO time. And the full disclosure of red earning prospect, this we already covered in the earlier slide. And the major difference for Indian and international is here. If you go for the international, there is not big compliance part, so there are no profit restrictions. Indians it was there, but international there is no profit side. So they need to regulate their bodies. Generally we use SEBIs and they use these regulators, but there are a lot of flexibilities in international IPO than Indian. There are only one disclosure based regimes. So if you go international IPO procedures, they can hire one investment bank and due diligence they file this. So here they don't need that SEBI red earning prospectus and everything has been missing in USA or some other international IPOs procedures. But we in India we need to follow. And then after this file, they will show road shows. Here they will disclose everything, how the company and what are their plans and how will then. And then they will give pricing and list on the exchange. If they get there, it will be listed. So this is a simple route from international. Key differences. In India, there are some eligibility and we need to disclose some red earning prospectus here, draft red earning prospectus SEBI. For international, only disclosure that you don't need any eligibility criteria in international markets. So India, there are strict rules you can say. So international, there are some flexible when compared to Indians. This is the major differences. And if you go to tax issues for company in IPOs, if it is an IPO, company will receive the money. So with this procedure, capital receipt they are not taxable. So in this case, there is no taxability for company except private companies. If you go for the private companies, if they receive securities premium or shares premium, that will be taxable under 52 subsection 2 as an more than the market. If the market value is 100, if you get the share price is 150, the balance 50 rupees is taxable under this section for private companies. This is not applicable for public companies. So if it is an already listed company, you don't need to compile these two. While if you go to private companies, these condition will come. And then existing tax gains, I mean already existing shareholders, the promoters and who are the existing shareholders were there before listing, right? What are the conditions for them? So they might transfer their shares to IPO. I mean, while in IPO, they will share transfers to the new shareholders. Then either they will get short term or long term capital gains based on their time period of that IPO, because generally if you go by the profitability route, that will come long term only, because the conditions should be 5 years and 3 years are there, right? So that will be long term only. If they go by institutional bankers, that route, that will, there might be long term or capital bank based on the company's existence. Under these sections, these are the taxable. And then new shareholders. For new shareholders, at the time of allotment, no tax implications, because they buy the share. Only tax come on the sale by either long term or capital short term capital gains based on their holding period. And then dividends will come if they hold the shares between the period. So these dividends are generally taxable on the regular tax slabs. Then these are the non-residents. If any non-resident investors has been invested in your company, these are the conditions. They will also come, long term and capital gains taxes will come, but they will get DTA benefits, you know, right? Double tax evidence agreement. If your long term capital gain tax is 10%, but but that particular sale of transaction, if DTA mentions either 8 or 12, whichever is benefit, if it is 12 they will use this rate, and if it is 8 they will use 8 rate. Whichever is beneficial they will use in general. So these are the conditions for the IPO. I hope you understand. For this kind of interesting videos, please subscribe our channel. Thank you.